It has this evening approved the draft Financial Services Authority Bill 2016, which seeks to merge the functions of 4 major financial regulatory bodies. The decision, which has far-reaching implications for the financial services sector, was reached after a long tussle and will now see many hitherto and strong independent regulators lose critical control of particular areas of the economy. The move to merge several financial regulatory bodies by Cabinet is viewed as a step in the right direction by the government to cut bureaucracy and spur investments. The nod by Cabinet will see the Financial Services Authority take over functions of the Capital Markets Authority, the Insurance Regulatory Authority, the Retirement Benefits Authority, and the Circle Societies Regulatory Authority.
The vision seeks to create a robust, inclusive, efficient, stable, and globally competitive financial services sector that promotes savings, mobilization to finance long-term development.
In a recent interview with Nairobi Securities Exchange Chief Executive Officer Geoffrey Odundo, he told KTN this was inevitable.
We recently went to Qatar and just had a meeting with the Qatar Financial Reporting Center to just understand how the whole ecosystem works. And I can rightly put that Kenya is really well established in that direction. I think if you look at our ecosystem, it has all the features that any financial center has to have.
Although it is not clear whether staff working at the said authorities will be affected, the government maintains the purpose of the decision to merge is to provide a consolidated supervision for financial services, to eliminate regulatory gaps, and to increase the protection of consumers of financial services.
Separate regulators has been beneficial in that they've helped the specific industries also grow in terms of standards, in terms of products. And even the investment groups. So if you look at the Capital Markets Authority, which is a regulator for the capital markets, a lot of revolution has taken place to the point that today we now have an exchange-traded fund.
Essentially, the cost of complying with the regulation becomes too heavy, while the aspiration is to have one single regulator.
Kenya being among the leading mature markets in East Africa, the push to merge the watchdogs is the initiative to reduce the number of regulatory bodies all working in the same field. Under the proposed bill, all non-bank financial services providers will be licensed by the FSA through a single license. The authority will have a full range of administrative and enforcement powers. Observers say it is still too early to know how the merger will affect the sector in its entirety. Kenya's peers such as Rwanda are already steps ahead on this front. Abi Agina, KTN Business.